Hey there, it's Seb Frey, the Realtor, and I'll bet you're wondering, does today's rate hike by the Federal Reserve mean we're going to see a decrease in Bay Area home prices? Watch this video and I'll tell you all about it. Hey, before I get too much further along, do me a favor, would you please smash that subscribe button right there and subscribe to my YouTube channel so you can get notifications when I put out fun, cool, and informative videos just like this one. You probably heard that today the Federal Reserve raised the short-term interest rate by 1/4 of a point. And so a lot of people are saying, well, that means that it's going to be more expensive to borrow money, including to borrow money for a home loan. And that may or may not be true. The thing is that there's no direct tie between the federal funds rate and the mortgage rate you pay when you borrow money to buy a house. So when the Federal Reserve rate goes up, bond yields tend to go up. And when bond yields tend to go up, mortgage rates tend to go up. And a lot of people think that rising mortgage rates mean that home prices come down. But is that always true? Well, I'm going to talk about that also. But first, let me talk about the fact that the Federal Reserve just raised rates today, but yet mortgage interest rates have jumped up by about 1.25 points over the past couple of months or so, maybe 6 to 8 weeks. The mortgage interest rate has shot way up. There is no direct correlation between the Federal Reserve rate and the mortgage rate that you pay. The fact of the matter is that mortgage markets have priced in the anticipated rate that the Federal Reserve was going to increase for some time now, because the Federal Reserve has been saying for quite some time that they plan to have several interest rate hikes this year. And so the mortgage market, they knew all about that, and rates have been rising for quite some time. So there's no direct correlation between the two. Mortgage rates can go up or down irrespective of what the federal funds rate is doing. So that's just one thing to bear in mind. And so the short answer to the question is, will the federal funds rate hike impact Bay Area home prices? The answer is no, it will not. There's no direct tie between the two, even a little tiny bit. Now, the other question is that, okay, well, since mortgage rates have risen so much, is that going to have an effect on Bay Area home prices? And that is a more fair question, I think. And the reality is, no, that's not going to happen either. And how do I know that? Well, we can just look to everything that's happened since January 1st of this year. What's happened? Interest rates have shot up by 1.25%. They've gone from a little bit under 3 to a little bit over 4. That's a pretty substantial increase in the mortgage rates. And yet, do we see any change in Bay Area home prices? Well, yeah, hell yeah, we have seen a big change in Bay Area home prices. They've gone way up while mortgage rates are rising as well. Here's the thing. The Federal Reserve, it has two jobs. I've mentioned this before. Two jobs for the Federal Reserve. Job number 1, full employment. Job number 2, to fight inflation. So the Federal Reserve wants to have inflation rates somewhere in the range of 2 to 2.5%, and right now it's around 8% for inflation, so it's way out of control. So now that we have basically full employment, the Federal Reserve needs to step in and apply the brakes to the economy, because I don't know what talking head you're listening to besides my beautiful talking head, right? But there's many talking heads on TV, and they'll tell you various things like maybe the economy is not doing so great, and maybe that's true in Peoria. But over here in the Bay Area, guess what? The economy is rip-roaring. Things are going along just fine, and there's a tremendous demand for money. And this demand for money, it allows people to borrow money, right? When I say demand for money, it means borrowing money, right? So when people are borrowing this money, they're taking that money and they're buying stuff, right? Like it comes from consumer credit. You go down to Best Buy, you buy a gigantic TV, or you buy a car, or you buy an airplane, or maybe even buy a house. And so, this cheap money that we have right now, because the rate has been so low, the Federal Reserve needs to do what it can to increase the cost of borrowing, to decrease the amount of money that people are injecting into the economy by buying goods, and that the idea is going to bring down the rate of inflation, which I think is a good thing. We can all get behind that. Like, we don't want to have runaway inflation. Does anybody remember stagflation from the 70s? I kind of remembered it a little tiny bit. I was a little kid back then. And even I remember, the late 70s, kind of sucky time, right? I don't really want to see us go back to that. So here we have the Federal Reserve raising interest rates in an effort to decrease inflation, and that will probably at some point, continue to have more of a push on mortgage rates. We could see mortgage rates rise today from 4%, they could close out the year at 5%. And I should say that nobody really knows. We haven't even finished the first quarter of the year yet. There's a lot to go. All kinds of things could happen. I mean, we have this war in Ukraine, could get a lot worse, could be World War III, who knows? Any number of things could happen along the way to alter the course of the Federal Reserve's plans. There could be massive changes in the economy still. Coronavirus could come back with this new killer strain B8.2 or whatever it's called. I mean, we don't know. The future is not exactly set in stone, shall we say. So it's impossible to say what really is going to happen. But if we continue along the same trends that we're going on right now, which is a very strong economy, the fact is the economy is creating new jobs. The economy is creating better paying jobs. And what does that mean? That means that the consumers have more cash in their pockets. Also, the stock market today, when the Federal Reserve raised interest rates, did the stock market tank? No, the stock market did not tank. The stock market did what? It jumped up. The market liked the move today by the Federal Reserve, right? So, these stock market gains are what is in large part fueling our local real estate market, because around here in the greater San Francisco Bay Area, at the prices people are paying for housing here, most of these buyers are not excessively, sensitive to mortgage interest rates, right? If rates rise by 1% or 2%, what's the solution there? To put more cash down and to make their monthly payment something which is more palatable to them, right? There's a great deal of capacity in our local real estate market to absorb higher interest rates. And remember, these rates are only going to be rising if in fact the economy continues to do well, creating those jobs and adding, more dollars to everybody's paycheck. So nothing happens in a vacuum. And if you were to go back and look historically and see what happened, to home prices in the face of rising interest rates, and I'm sorry, I don't have a graph handy right now. I've done this analysis in the past. I've gone back and I've looked to see home price appreciation and mortgage rates. There's many instances where interest rates are rising at the same time home prices are also rising. And that is because, again, home prices have a lot to do with how much money people are bringing home. That's why home prices in the Bay Area are so high, because incomes are so high. So I think the question is, what would it take to bring down Bay Area home prices? What it would take is a significant drop in local paychecks in order to take the air out of the real estate market. But the reality is, while the economy continues to remain strong and people are continuing to see increases in their paychecks, I predict that we're going to continue to see increases in Bay Area home prices, that we're not going to have some calamitous drop in real estate values simply because the Federal Reserve raised rates and then mortgage rates went up another point or two. So I hope that answers your question. There's no need to freak out if you're a home seller. Just know that the buyers are still going to be there and they're still going to be able to pay a lot for your home so long as the economy continues to remain in very good shape. All right, that's it. But listen, before I sign off, once again, I'm going to implore you to smash that subscribe button right there and subscribe to receive notifications when I put up a new video, sort of, a little bit maybe like this one on my YouTube channel. All right, hey, thank you so much for watching. I really seriously do appreciate it. Stay tuned.